Imagine you work hard for an entire year. You save up, you sacrifice, you skip the vacations, the dinners out, the little luxuries, and then you lose it. Not all of it, maybe just half, but enough to feel sick. Here's the crazy part. This doesn't just happen to beginners. It happens to doctors, lawyers, engineers, smart people, educated people, people who did their research. So what's going on? Why do 90% of people who enter the stock market end up losing money? That's exactly what we're going to find out today. Meet Alex. Alex is 28. He works a regular job. He pays his bills. He's not rich, but he's responsible. One day, Alex hears something. His coworker, Marcus, walks in on a Monday morning with a big smile. "Dude, I made $800 this weekend, just from stocks." Alex stops. $800 in a weekend without working. That sentence lives in Alex's head for the rest of the day. So Alex does what everyone does. He Googles it, and the internet does not disappoint. He finds videos of people showing off their profits, courses promising financial freedom, apps that make investing look like a game. If you put $10,000 into an S&P 500 index fund 30 years ago, you'd have over $170,000 today. The math is real. The potential is real. So he downloads the app. He puts in $2,000, his first ever investment, because knowing the destination and knowing the road are two very different things. The stock market isn't a savings account. It's more like a chess game played against thousands of other people, some of whom have been playing for 30 years, and some of whom have computers doing the playing for them. But Alex doesn't know that yet. The market opens on Monday. Alex watches his phone. His $2,000 goes up to $2,080. He's up on his very first day. He feels like a genius. And that feeling is the first trap. When people make money, their brain releases dopamine, the same chemical as sugar, social media, winning a game. It feels good. And when the market drops, cortisol floods in. Suddenly, he's not thinking clearly. He's reacting, and reaction, not strategy, is where most people lose. The average investor earned less than half of what the market actually returned. Same market, half the result, because people kept buying high and selling low, the exact opposite of what they should do. Alex is on a hot streak. He's up $300. He starts looking at individual stocks. Someone on Reddit says a certain tech company is going to the moon. Alex doesn't know what the company does. He doesn't know its revenues, its debt, its competitors. He just knows people are talking about it, so he buys. When you buy a stock, you're not buying a number on a screen. You're buying a tiny piece of a real business, a business with employees, expenses, customers. If you don't understand the business, you're not investing, you're guessing. And guessing against people who've studied that company for years, that's a tough game to win. This one is sneaky. You might not even notice it happening. Let's say Alex moves some money into a mutual fund. Sounds great, right? Except that fund charges a fee every year. After 30 years with no fees, around $100,000. After 30 years with a 1.5% annual fee, around $64,000. That's $36,000 gone. Not lost in a crash, not stolen, just quietly eaten by fees, year after year. And the painful truth, most actively managed funds don't even beat the market. Over a 15-year period, around 90% of actively managed funds perform worse than a basic index fund. After a few months, Alex thinks he's figured something out. He starts trying to predict the market. He sells before he thinks it'll drop. He waits and waits, then buys back in when he thinks it's safe. Between 1996 and 2015, if you missed just the 10 best days in those 20 years, your return dropped nearly in half. Most of those best days happened right after the worst crashes, right when everyone was scared and pulling their money out. The people who tried to wait for the right moment missed the moments that mattered most. Most people enter the market with a vague goal. I want to make money, but they don't know how much. They don't know their timeline. They don't know what they'll do if things go wrong. It's like getting in a car and saying, I want to go somewhere nice. You might drive in circles until you run out of gas. When the market crashes, people with no plan panic. People with a plan check their strategy. They breathe. They stay the course. The difference between Alex and Diana isn't intelligence, it's preparation. 6 months later, Alex lost $600 of his original $2,000. Not because the market was rigged, not because he was unlucky, but because he played a game he didn't fully understand. But here's the turning point. Alex doesn't quit. He asks a different question. Not how do I make money fast, but how do people actually build wealth? And that question leads him to George. George is 61. He's not a millionaire from a lucky bet. The market rewards patience more than genius. 35 years of consistent, boring, disciplined investing. He never tried to time the market. He bought index funds with low fees. Because patience doesn't sell courses, it doesn't make headlines, it doesn't go viral, but it works. He closes his trading app for good, opens a simple index fund platform, sets up $200 a month, automatic, consistent. $200 a month into a simple, low-cost index fund, not trying to beat the market, just trying to be in it, consistently. The market crashes the next year, and Alex, he doesn't sell. He keeps contributing, because now he understands a crash isn't the end of the story. For a long-term investor, it's a sale. So why do 90% of people lose money in stocks? Emotion, buying what they don't understand, hidden fees, trying to time the market, and no plan. The 10% who win aren't smarter. They invested in things they understood, kept fees low, stayed patient, had a plan, and stuck to it. You don't need to be a financial genius to build wealth. You need time, discipline, and a clear strategy. The market doesn't care how smart you are. It rewards how patient you are. Every wealthy investor you admire, they all started exactly where you are right now. If this changed how you think about investing, share it with someone who needs to hear it. Subscribe, because next time we're covering exactly what to invest in when you're just starting out.